welcome. I hope everyone had a wonderful Thanksgiving filled with family, friends, and good food. As a follow-up to the well-attended April 2022 Expo panel on family-owned business succession, NPGA is offering a series of 3 webinars on succession planning. Today is the second in that series and is on the transition of operations, legal impacts, and governance changes. The final webinar in the series will be on December 16th at 11 a.m. Eastern on options that family-owned businesses have, whether that's generational transition or selling to a larger company. Registration for the final webinar will run in the bobtail starting about 2 weeks in advance. Today, the presentations will run about 40 to 45 minutes with 15 minutes for questions. Questions can be submitted through the question box. So we are going to focus on how the corporate structure impacts a transition, how an effective governance strategy formalizes decision-making for a family business, and how a transitions structure influences both parties. Our presenters today are both from Cetane Associates. We have Fred Lord and Tamara Kovacs. Fred brings over 40 years of experience in the delivered fuels industry in various operational and financial management roles. Before joining Cetane, he was with Hop Energy and its predecessor as corporate treasurer. Fred has been involved in more than 80 acquisitions during his career. A non-practicing attorney, his expertise extends the capabilities of Cetane's transaction execution team. And Tamara has spent over 20 years in the retail propane and delivered fuels industries, with much of that time performing M&A advisory, business consulting, transition planning, and business valuation services. Prior to joining Cetane Associates, she spent 23 years with Propane Resources in various roles, including senior advisor for their M&A consulting group. Tamara holds a bachelor's degree from the University of Missouri-Columbia, as well as an MBA from Baker University. So with that, I am going to turn it over to these fine folks to present to us on this topic. Thank you very much for your time. We really appreciate it. And hopefully folks have a lot of questions and we can engage in some good conversation once the presentations are done through questions in the chat box. So I'm going to turn it over to you guys.
Okay. Thank you for the introduction, Steve. Welcome, everyone. Tamara and I are excited to have you here. And we thank you for taking time out of your day to attend this webinar. If you have questions, please type them into the Q&A box, and we will try to answer them at the end of the presentation. I have to provide the following disclosure, since we are not a law firm. The information provided in this webinar does not and is not intended to constitute legal advice. Instead, all information, content, and materials available via this webinar are for general informational purposes only. Viewers of this webinar should contact their attorney to obtain advice with respect to any legal matter. And as Steve discussed, the purpose of this webinar is to discuss in terms of family businesses, how your legal corporate structure, your governance practices, and how a transaction is structured will affect the family business and give you the most value for your company. The time to think about your exit strategy or transition strategy is the day you start the business. Obviously, most companies don't do that. They're just happy to get the business off the ground. So it's never too late to start planning for transition and succession. And the earlier you start, the better off for you. Businesses are typically known to have 5 stages of or cycles. There's the startup phase, when you get up and running. Then there's a growth period where the company grows not only in revenue, but number of employees and profitability. After a while, you reach maturity. It's kind of a steady state of affairs. And, the company is chugging along, hopefully earning some good money. And except for variances due to weather, hopefully the earnings are relatively stable. Then there's a transition stage, which we'll be concentrating today with the stages that begin with maturity, going to transition, and then succession. But both stages 4 and 5 are, where the company is getting ready to change ownership. There are 4 types of legal structures. Tamara will go into them in more detail, and I will as well in the next few slides. But we're going to discuss C Corps, S Corps, limited liability companies and limited liability partnerships, and also sole proprietorship.
So first of all, let's talk a little bit about a C corporation. So C corporation is a legal structure for the corporation in which the owners and shareholders are taxed separately from that entity. And C corporations allow the owners and officers of the business to actually be legally distinct from that business itself. A lot of, owners, whenever they choose to set up their legal structure, they look at the ease of filing the taxes for shareholders as one reason why, C corporations are favorable or that they like them. Another key point about a C corporation is you can have an unlimited number of shareholders. So there's no cap on that number of shareholders that you can have. One thing to note about C corporations, however, is if you're doing asset transaction whenever you actually sell the business or transition the business, is you're subject to that double taxation that a lot of people hear about. And what that means is when you sell the company, you're taxed at the corporate level, but then when you take distributions, you actually get taxed a second time. That's that double taxation. And we've worked with a lot of companies that are C corporations, and they say, you know what, I'm looking at selling my business, and they elect to convert from a C corporation to an S corporation. And so when you actually do that filing at that time of filing, know that there's going to be a waiting period. Right now, that waiting period is 5 years. So before you can sell your business and actually be taxed at that S corporation rate, you have to wait 5 years. It's not always been 5 years. There's been periods when it's been 7 years. There's been periods when it's been 10 years. So know what that time period is when you make that election. Best laid plans, everything comes together perfectly. You've got your runway. You say, you know what, I've got 5 years that I want to run the business before I sell. So let's go ahead and do that election now. But life happens, right? There's things that, come up in our lives that may say, you know what, we need to sell the business before the end of that 5-year waiting period. So what we always recommend is have a valuation done at the time that you do that conversion filing, so that if you do have to sell prior to the end of that waiting period, any value that you have increased in the business since the time that you filed, when you sell prior to the end of that 5-year waiting period, any increase in value, you can actually have taxed at the S corporation rate. So that's some tax savings right there. So it's something that I would definitely recommend when you do that conversion from a C to an S, also have a valuation done so you can set that baseline. The next legal entity that we're going to talk about is an S corporation. And S corporations, you can elect to pass the corporate income, the losses, deductions, credits through to the shareholder for income tax purposes. So that's that pass-through that we talk about. So it's a little more complex when you're filing your taxes. Another key thing about S corporations, again, just like a C corporation, is that you're allowed, the owners and officers of a business are legally distinct from the business itself. With an S corporation, however, you can only have 100 shareholders. So you're maxed out at 100. But again, when you choose to sell a business, you do have more favorable tax treatment when you sell.
A limited liability company is a legal structure, and that's actually determined by state statute. Depending on the elections that a limited liability company makes, it can either be taxed as an S corporation, a corporation, or as a partnership. The advantage of a legal limited liability company is that it separates the liability of the company from the individual owners. A limited liability partnership, it has partners, and typically responsibilities are laid out in a partnership agreement. A limited liability partnership is really used primarily in professional organizations such as lawyers, consultants, and medical offices. I've not run across one in the delivered fuel segment. A limited liability company can be either a single member or a multiple member. Single member just means that it's one owner, and that can either be taxed depending on the election as an individual or as a corporation, or it can be a multiple member, and those members can be any type of entity. They can be individuals, they can also be corporations, companies, or partnerships. And again, for the LLP, that can either be just one partner or you can have multiple partners. The final type of ownership is the sole proprietorship. We do not see those as clients. Every now and then we might get a call about somebody who's either wants to grow or sell their business eventually. And we would tell them to, form some sort of corporate shell. But a sole proprietorship, as I said, there's no form of business structure. There's no protection from liability for the owner operator, and there's no separation of liabilities or assets from the owner. So anything that is used in the business or occurs because of the business, is also the personal responsibility of the sole proprietor.
So we've talked about the different legal entities. Now I want to talk about governance, because what governance really means is it's, a process to oversee the control of the direction of the business. And that's really why it's, you want to know what the direction is, and you want to have a process in place that really dictates that governance of the business. Because you want to make sure that everybody knows, that has ownership in the business, knows what those goals are. And the time to actually think about, having a governance plan is when you do the startup or before you do that startup. That's the optimal time. But many of us, many businesses have been in business for years. So the second best time to put together a governance plan would be before there's any type of change in ownership percentage. So you need to be thinking about that. So it's a really good practice to go through. So there's two strategic alternatives for a business's future, typically, that we see: maximize the company's value and sell it, or grow the firm for future generations. So when you're thinking about that, growing the firm for either one, really, you're thinking about that, governance process, a governance plan. And really, that whole goal is, so like I said before, so everybody knows, what the plan is going forward. So it's really to help set up the processes for good making or being able to make good decisions going forward. So let's talk about family governance. So, family governance consists of the processes in place to govern decisions involving the family and the business and the intersection of the two. So, you know, having a strong family governance is critical for, you know, is a critical characteristic of a family business that is going to be successful over multiple generations. And the other thing is a strong family governance is really beneficial for generational transfers. So holding a multi-generation business together is challenging. Running a business itself is challenging, and then you put family dynamics in it, and it can get very, very challenging. Each family member has different needs. You know, they're a different age. You know, they have different income needs. They're, you know, different marital status. They have different goals, both professional and personal goals. And family dynamics can lead to the downfall of a company if you don't have really good governance planned in place. So let's think about establishing that governance strategy. You know, one of the things is you want to make sure that you have family meetings, and you want to have all different, you know, active participants, you know, non-active participants, passive participants being involved in those family meetings. And you want to make sure that those family meetings are professional, you know, treat them like a board of directors kind of thing. You also want to have a family council, and you want to have proper representation at that family council. And what we mean by that is, you know, like I said before, you've got, you know, active participants, or whether they're active in the business and management or employees, you've got passive family members who may not be involved at all. You want to have some kind of representative for all the different types of family members that have ownership in that business. So let's talk about what the objectives of a family council are, really. So the objectives of a family council is you want to establish a process to handle family conflicts. You want to deal with them very quickly. The last thing you want is for some kind of family conflict to really get out of control, and it can happen very, very quickly. You want to have, what's the formal process, what's the informal process, what's the formal process, and have that outlined so that everybody understands, here's how we're going to handle those. You want to provide direction to the board of directors on family expectations and the family culture. You want to specify, you know, what's the general business direction? You know, what are we going to do there? And you want to be able to communicate that to the extended family, because, you know, there may be a lot of family members who aren't involved, but you want to make sure that communication gets passed down to them so that they understand what's happening. And there's things that, you know, you need to discuss, you know, and communicate. I meant to mention one of the family specific, or the specific general business direction. One thing that's really important in that is you need to know, you know, what are the acceptable risks we're going to have, and you need to have everybody have buy-in. You know, if we make an acquisition, you know, what kind of risk are we willing to take? You know, when do we make quarterly, you know, cash distributions? Is it going to be quarterly, or, you know, what's going to be the mechanisms that's going to allow us to make those distributions? Those are some of those general business direction decisions that should be made, and everybody should have understand what they are, and it, you know, saves a lot of conflict down the road. And that's part of that communication. If something changes, if new things come up, make sure that you're communicating those with the family members. And again, like I said, make sure those meetings are formal. You know, treat them like a board of directors meeting, and make attendance a requirement as part of that.
I'm going to talk about business governance now, which is a little different from family governance in that family governance is the primary goal is to protect the interest of the family and make those clear among the family members. Business governance is for the business organization as a whole, and it governs how decisions are made at the corporate level. The key components of business governance are the shareholder or operating agreements, depending on the type of entity involved. A shareholder agreement is for a C Corp or an S Corp, and the operating agreements are for LLCs. The shareholder or operating agreement is very important. And in most of the transactions that I've been involved with, the owners can either not find the shareholder agreement or have, really just don't know where it is. Usually it's with the lawyer's office, and it hasn't been looked at in years. And that's okay, because unless some shareholders agreements are important at 2 points: when there's periods of conflict and also during periods of transition. So I think it's important for everyone to take a look at their shareholders agreement and modify it if needed after reviewing with their attorney. The shareholder or operating agreement, they're signed by all the owners and they're contractually binding. That's very important. The board of directors and the family council must follow the directive in the shareholder agreement. The items below are addressed in a shareholder operating agreement. They're not all inclusive, but these are some of the key items that are covered. Who can own shares? There are restrictions on selling equity. Does it have to be to a family member? If it's not to a family member, does it require a supermajority vote? It'll address triggering events for buy-sell transactions of the stock or membership interest. That's usually either the death of a member or a shareholder, or a disability. It'll establish the company's board of directors, determine how many directors there will be, and how frequently the board will meet. There'll be a provision on how often valuations will be done. There'll be discussion on the rights of minority shareholders. Will the minority shareholders be given a vote or not? And again, as I mentioned before, sometimes you need a supermajority of ownership votes required to make changes. And that supermajority is usually like 66 2/3 or 75% of the shareholders. And that usually for major items such as the sale of the business, maybe the purchase of another business, or a major refinancing. The agreement will discuss a policy for cash distributions, and also it might have a provision for how family members will be hired or terminated.
So succession planning is something that gets talked about a lot with family-owned businesses and even non-family-owned businesses. But to talk about, okay, what's going to happen next, And unfortunately, a lot of people don't do the succession planning. A lot of those, people in management currently don't do that planning because family members, a lot of them are really worried about, is there going to be some kind of a conflict? Because a lot of times it triggers deep emotions. Probably we estimate, or it's estimated that less than 25% of family businesses have a succession plan in place. So let's talk a little bit about a succession plan, because there's a lot of triggering events that could occur that would force you to put that succession plan in place maybe sooner than you wanted to. So you always kind of want to be thinking about it and preparing for it. And those things could be death, some kind of disability or health issue. Maybe there's family disputes that trigger it, retirement, sometimes divorce. I mean, there's a lot of different triggering events that could put that succession plan into place and trigger that. So, one of them is prepare for the unexpected and the inevitable. That way you're ready at any point in time, because it can happen. Life happens, like I mentioned before. And a key goal of a succession plan is to obtain consensus of all the family stakeholders. A succession plan should address the needs and concerns of the current generation, the next generation, the employees, other stakeholders. And we also mentioned suppliers and banks, because if you think about it, suppliers and banks want to make sure that the company is going to be successful financially going forward. Are they going to continue to extend those credit limits and those kinds of things to that next generation, that next succession that's going to take over? So that's really important. And have key management, key management and employees also need to believe that the company's survival is going to, be strong going through the transition. Because, you can have a really strong company. If you don't have a strong succession in place, it doesn't mean it's going to be a successful transition. So some key components of the succession plan is you want to be sure, and well, first of all, before I go there, I want to mention if you're a really large company or large estates, you may want to talk to an estate planning attorney, because they can provide some tax savings that can save the family enterprise a lot of wealth. And sometimes it's more than a couple of operating years worth of profit. And to me, it's worth at least exploring that avenue just to make sure that you've, uncovered every stone to make sure that you can, save as much wealth as you can for that family enterprise. But you want to create an aligned ownership group, people that have the same goals and visions of how the company is going to be run going forward. You want to, develop, assure that the next generation is taken care of. So have some personal and financial planning in place for the retirement and estate planning for that, because it's really make sure that you've got a plan in place to take care of those people that are leaving the company. That way that they have a good retirement set forth as well. Management is critical. Make sure that you've got a really strong management in place for implementing those business strategic plans after the transition. And that's part of that planning ahead of time. How's the company going to grow and develop, and what do we need to have in place, and who are the best people to meet those goals and objectives? Personnel development. It's not like we're going to transition the company in 6 months. Let's go ahead and start training these employees on these new responsibilities that they're going to be taking over, or these new family members with these new responsibilities. This is something that can take years in the making to do a smooth, successful transition. So start doing that early on. And again, develop a communications plan so that you're communicating the succession plan, the transition, and what's going on to all the different stakeholders of the company, because they need to be informed as well. But know that there are some pitfalls that you could encounter and should really think about as well. If there's minority ownership involved in the company, if they were to sell that minority ship, typically there's a discount for that, because they don't have, a lot of control as far as decision making, those kinds of things. And a lot of agreements prohibit minority interests from selling their shares outside of the corporation. They need to sell them inside. Not all, if somebody is looking to, sell their shares, not everyone would necessarily discount it if they're buying it within the company. Some may say, no, we're going to give you the full value for it. It really is dependent upon, what the owners and the seller are thinking about doing, the buyer and the seller. Minority shareholder power. Just because you're a minority owner does not mean you don't have power and can really wreak havoc on the business. For example, take a quick example. You've got 3 owners. The owner who's involved in running the business has 40% of the business. You've got 2 other siblings that are not active in the business, and they each have 30%. But if those 2 siblings with 30% get together, their combined power is now the controlling power in 60%. So think through, how do we hand down these, ownership percentages? Who has them? And do you have a plan in place or an agreement in place that says who has what kind of authority, even though they may have the ownership? That's why those governances are so important. Those governance plans are so important. There's also situations that we've run into that we call them partner hostage situations. And that depending on how the agreement is written, we've seen agreements where they're written that every shareholder, no matter what their interest is, has to vote to sell the business. And you could be a 5% owner of a business, and actually stop the sale of a business depending on how that agreement is written, unless you get what you want out of it. So, it's really important to understand, how those agreements are written and, what kind of power, you're giving, some of those partners. Non-compete. The other thing I would recommend is everyone is required, and this should be part of the governance, everyone's required when they, sell their ownership of the business to sign a non-compete for a period of time. This doesn't matter even if you're selling to a third party. That can actually, stop the sale of a business, cause it to fall apart. The other thing to think about is you have a family member who gets disgruntled, sells their shares back to you, and then turns around and goes and starts competing 5 miles down the road. So something to take into consideration why you definitely would want that non-compete in place. So there's two really types of transactions. You've got an asset transaction and a stock transaction when you're looking to sell the business or sell your shares or of the business. So we're going to talk about, asset transactions are the ones that we see most often in the propane and fuel oil world. There are stock transactions, but they're there's far fewer stock transactions performed than asset transactions. And Fred and I are going to talk through why that is. Primarily, we'll see a stock transaction if it's a really large deal, or sometimes if it's a family transaction. So let's talk about those buyer advantages for an asset transaction. And an asset transaction is where you're purchasing the individual assets and liabilities versus the stock of the business. And the thing is, the dollar number is important, but the tax implications and the potential liabilities are also primary concern to take into account. So one of the key buyer advantages for doing an asset transaction is they can restart the depreciation of those acquired assets. And if you make an acquisition in 2022, you can actually take 100% depreciation recapture on those qualifying assets. In 2023, you get 80% immediate depreciation recapture on those qualifying assets. And then it also goes down 20%, at least right now, the way it's set up, it goes down 20% each year after 2023. Sorry. Liabilities prior to the sale remain with the seller. Select employees, you can just determine which employees you want to hire, and it doesn't impact your unemployment rates, because in an asset transaction, the seller actually has to fire the employee, and then the buyer rehires that employee. Right now, in this environment, we haven't seen a lot of issue with that at all anyway, because everybody wants employees. They're so difficult to find right now. And the buyer also, it's easier for the buyer to determine which assets they want to purchase or exclude. A perfect example of this would be if a seller had a lot of accounts receivables that are, really old, they may choose not to buy those receivables, as an example. Buyer disadvantage for an asset transaction is you have to treat it like a startup, right? You have to get new licenses, new permits, new DOT numbers. If you're going to do a DBA, you've got to get that set up. You've got to start those contractual relationships with suppliers, service and other service companies, those kinds of things. It costs more money because you've got to transfer all the licenses over with, getting new title for vehicles, that kind of thing. The other thing that, has to be taken into consideration is, is there a valuable non-asset, or I'm sorry, a non-transferable asset that's really, really valuable? There could be some issues if it can't be easily transferred. And a lot of times that may come in the form of real estate or something like that. Are all the agreements that you have in place, are they assignable? We've had times where, certain agreements could not be assigned, and that could be a reason not to do the deal. So that's really important to understand as well, and it's a disadvantage for buyers. And then, key employee agreements may need to be renegotiated as well. So seller advantages for an asset transaction: the seller gets to keep the corporation if they want to, keep it open if they want to. They keep all the cash in the company. It's easier to exclude assets. If the company owns land and you want to exclude that land from the sale, it's much easier to do that. And there's fewer restrictions if there are minority shareholders. because, minority shareholders, not always, if it's an asset transaction, you can force them to go ahead and sell the business, sell, which is much easier to do than in a stock transaction. Asset transactions for the seller, the disadvantages, if they're a C Corp, you're going to get that double taxation again. And that we've already talked about that. You also retain any of those pre-sale liabilities. So any liabilities that happen prior to closing, they stay with you. You have to, the seller has to fire the staff and pay out any obligations. And then they're also required to, no, they don't have to, but if they're going to shut down the corporation, they also have to go through all of those mechanics as well.
Now transition over to stock transactions. The advantages, first of all, I just want to say, if the business is a sole proprietorship or a partnership or a limited liability company, you cannot do a stock sale because there are no shareholders. They just have members or the partners or the sole proprietor. The advantages to the buyer are that you're buying an ongoing business. There's no requirement to get new licenses or permits. You hit the ground running. The buyers can typically assume all non-assignable licenses and permits without having to obtain consent from any governmental agency, although there are often requirements that you have to report to the agency the change in the shareholders, but you still have the license. The other advantage is the staff rolls over to the new owner without any hiring and refiring, or firing and rehiring to be done. For the buyer disadvantages, they really fall into two main categories. The liabilities of the company, they stay with the company, and although the buyer can mitigate or even eliminate most liabilities through indemnification provisions, there's still more risk with a stock transition or being saddled with a contingent liability as compared to a asset purchase. There are two major tax disadvantages from a stock transaction to the buyer. Tamara mentioned before about depreciation. In a stock deal, there's no step up in basis at the time of the sale. The book value of the assets of the seller are what are transferred to the new owner. And often, those book values are going to be close to zero because of the accelerated depreciation and also the length of time that the sellers had the assets. There is a way to get around this no step up in basis in some transactions. That is if the seller has valuations done for the physical assets. But these apply only to certain conditions or of the companies and should only be undertaken after you've gotten advice from financial advisors as well as legal counsel. The other disadvantage of the tax disadvantage for the in a stock sale to the buyer is the how goodwill is treated. With an asset transaction, goodwill, which is the amount paid for a company above and beyond its tangible assets, can be amortized for 15 years on a straight line basis. But with a stock sale, that goodwill cannot be amortized, and can only be recognized by the buyer of in a stock sale when that buyer sells his or her stock in the future. Another disadvantage to the buyer is that they are assuming all of the company's employee plans, including retirement, other benefits as well. And if the buying company already has plans in place for its existing companies, that can be administrative hassle. And also, if the selling company has union employees, you certainly want to be on the lookout for any underfunded pension liabilities. To the seller, the advantages for a C Corp of a stock deal are mainly the tax treatment and the theoretical disappearance of liabilities. I think if a seller had his choice or her choice, it would always be to do a stock sale. You get a beneficial tax treatment because the corporate entity is going on and you're just eliminating your stock in the company. The seller has to recognize the gain on the stock, and that will be treated as a long-term capital gain, which is at a lower rate than the ordinary income is of the shareholder. The future liability of the seller disappears. Supposedly the buyer is assuming all of the liabilities, but what we see in practice is the stock purchase and sale agreement will include indemnifications where the seller will agree to pay the buyer in the future for any liabilities that are defined in the sale agreement, or also possibly contingent liabilities. The stock transaction is good when there's a family member purchasing the business. The new owner does not have to worry about getting the license, assuming the contracts, and getting consent. The family owner is intimately knowledgeable about the company and would be much more comfortable not with the knowledge there are no liabilities, or knowing the extent of the liabilities, which if there are liabilities, you can certainly take that into account on the price that you pay to the seller. The other advantage for the seller is that the staff rolls over to the new owner, which saves the owner from having to fire their current employees, which, even though the new employees are getting, or the employees are getting job with new owners in the asset deals usually, owners are still hesitant to say, I fired my workers. So that is a little bit of a comfort to the selling owner. And also, since the company is going on into the future with new shareholders, the selling shareholder does not have to wind down the business. Disadvantage in stock transactions. Usually the buyer will keep the cash in the business. But again, that price, the cash in the business, that should be factored into the selling price. It's more difficult to exclude the assets or certain assets. For example, if the this company owns real estate as part of its corporate assets, and the owner would like to keep that real estate so they can have some rental income in the future, you have to carve that out of the purchase price. And again, it doesn't make it impossible. It just adds makes it a little more difficult. Finally, I think stock transactions are more complex and costly. They require much more due diligence on the part of the buyer. And also it usually involves a higher level of legal counsel. It always seems to bring in the bigger city attorneys, who generally cost more.
Hey, Fred, I was going to say, Fred, before we move on to the next slide, I wanted to kind of circle back that if you are a C corporation and you want to sell, keep in mind it's the allocation of the purchase price that really is important to that after-tax consequences that you're going to face. Yeah, it will be double taxed, but there are some things to do to help mitigate that tax, or minimize that tax that you're going to pay. And you have to work with the buyer on this. But one of the things that is really unique right now is, like you said before, your cost basis in those assets may be very, very small, kind of thing. Whereas, especially think about tanks, that increase in the tank price, the new buyer, he may be wanting to put a lot more of that allocation of that purchase price to the assets. So any increase, any amount of value that they put for allocation over what your cost basis is, it's taxed at capital gains rate, which is that lower rate. Because typically, sellers want to put all the money to goodwill because it's taxed at capital gains. But that is an exception or a uniqueness right now that we're seeing, and a lot of buyers and sellers are working through that to try to minimize the tax for the seller, but it's also beneficial to the buyer as well, because they get more ability to write down those assets or take that immediate depreciation. The other thing you can do is you can get a personal goodwill valuation done and allocate a portion of that purchase price to personal goodwill, which gets taxed at your personal rate and only taxed once. But again, have that personal goodwill valuation done, because if you do allocate money to that, there's a chance that it will trigger an IRS audit. And if you've got that valuation done, it's in your arsenal to be able to present to them whenever that does occur. So I just kind of wanted to mention that it's the allocation of the purchase price can really help minimize the taxes that get paid for that seller of the C corporation in particular.
Final transaction structure, which I'll only spend a few seconds on, are mergers. I have never been involved in a merger and over 80 acquisitions, so they're very rare. They're difficult to do well. There's and the other complicating factor is that they usually want the company that's merging in with the other entity. They want the owner to stay on for a period of years, which often the seller is selling because he does not want to be in the business anymore. So, that ends our presentation. Thank you for listening and attending. And if you have any questions, we have some time to answer some. Thank you again.
Thank you.
Thanks, Fred. Thanks, Tamara. If anyone has any questions, please put them in the Q&A box. I believe I can see them, and I will read them and send them along to Fred and Tamara. I guess in the meantime, I have a couple of questions if anyone on the Zoom or the webinar does not. So first question, Tamara, you mentioned succession planning. My question would be, how formal is your succession planning that you see? Is this something that folks put on paper? Is this a formal document? Is it a contract? Is it informal? And then part two of that question is, how often is it looked at by most family businesses? So understandably, if you are looking to sell, you'd have a succession plan, but perhaps you have one in case of an illness or a sickness. So part two is, how often should that be looked at?
So I think, you're right. First of all, I'm going to tell you that a lot of the succession plans that are out there are very informal, but ideally, there'd be a lot of thought put into them. They would be written, there'd There would be a written copy of them. They would probably be kept with the attorney. The attorney would probably review them as well. So, I mean, to me, ideally, you want to have it as formal as you can get it. But I'm going to tell you the majority of them are probably not very formal if they have them at all. Like I said before, it's estimated only 25% of, family businesses have succession plans in place anyway. How often should you look at them? I would say at least once a year to refresh yourself to make sure there's no changes. I don't know, Fred, if you have a different thought on that, but to me, it's always something that should be, kind of at the forefront of your mind, because you never know when there's a triggering event that's going to happen that could force that succession plan to be, put into place immediately.
Yeah, I think that's very well said. In terms of valuations, it's rare to see a company do it every year, but I think it should be done every 2 to 3 years. That way, all the stakeholders have an idea of the value of the company. And also, to go back to the beginning of the question, I think for most firms, succession planning is really the estate plan of the principal owner or owners, and it's not known by other family members. So that's why we're trying to stress it's important to do, and it'll certainly make things a lot easier once you get to that stage where you're ready to transition the business either to a family member or sell it to an outsider.
Great, thank you. And it looks like I can see one question in the chat box. The question is, what is the effect of IRS family attribution rules play on the sale from one generation to the next?
That is beyond my knowledge. I would be happy to look it up. But yeah, I really could not give an answer on that.
No, I'm going to agree with Fred. I think you really need to talk with your attorney or your CPA to try to really understand that. And I'm going to say that it's also going to depend on your individual business and what else you have going on, because you may have a lot more assets that, may have an effect on that as well. But I'm with Fred. We can look that up and get back with that individual.
Okay, so if that person wants to follow up with Fred or Tamara, their contact information is on the slide right now. Does anyone else have questions? And I apologize if you put one in the chat and I don't see it. That's the only one I see. But I guess I'll ask a second question then. We just have a couple minutes left. And that relates to goodwill. Fred, you mentioned goodwill. What's the best way for a family-owned business to get a valuation of goodwill if you've never done it before?
There are firms that specialize in appraising the goodwill of the companies. And we could provide names of a couple of them if anyone is interested in having that done.
Is that a low five-figure commitment for a company, or more or less?
It should probably be in the $3,000 to $5,000 range, maybe a little above it.
Okay, that's good to know.
Yeah, and I think it depends on who you hire. I mean, I've seen, I know there were firms there that, a goodwill valuation would cost $20,000. So it really depends on the complexity of the business, I think, and then also who they hire.
Sure.
So.
Okay. Well, I don't see any other questions in the Q&A box. So with that, I think we will wrap this up. Thank you very much to our friends from CTAN for presenting. And like I said, we have another session on family business transitions coming up in mid-December. So be on the lookout for registration for that. And with that, hope everyone has a great rest of your week. Thank you very much for joining us.
Thank you.
Thank you very much. Bye, everyone.
Bye-bye.